If you ask the average person where money comes from, they will usually picture a central government printing press, physically stamping out bills and minting coins to match the needs of a nation. But physical currency only makes up a tiny fraction of total wealth. The vast majority of a nation's money supply is actually manufactured out of thin air by the commercial banking system. This invisible manufacturing mechanism is known as the credit creation process. It is the engine that drives modern economic growth. Now, consider how we treat the money we earn. In our personal lives, saving money is a virtue. Building a reserve is a necessary, rational defense against individual financial ruin. But macroeconomic systems do not obey household logic. If everyone in an economy executes this virtue of saving at the exact same time, the credit creation process completely stalls, wiping out aggregate output and triggering a recession. To understand why an economy suddenly booms or crashes, we have to look under the hood. We need to see exactly how this invisible engine of credit is built, how policymakers throttle it, and how our own instinct for self-preservation can tear it apart. The foundational unit of the modern economy is the commercial bank's balance sheet. This balance sheet displays the financial position of combined registered banks. Notice the absolute rule of accounting at the bottom. Total assets must perfectly match total liabilities. This reveals the core contradiction. When a customer deposits money, they consider it their asset, but to the bank it is recorded as a liability, owed back to the depositor. The bank cannot pay operational costs if deposits sit idle. They convert liabilities into profit-generating assets by issuing loans. However, banks operate under a strict regulatory speed limit. They are legally prohibited from lending out 100% of their deposits. They must keep a specific percentage on hand, known as the required reserve ratio. Because banks are permitted to lend out the vast majority of their liabilities, every single dollar deposited into the system is primed to create multiple dollars of brand new debt. Let's build a model. We start with primary expansion. A customer deposits $1,000 into Bank 1. Applying a 20% required reserve ratio, Bank 1 holds $200. The remaining $800 is issued as a loan, spent in the real economy and deposited into Bank 2. Bank 2 holds 20%, $160, in reserve. It loans the remaining $640, which is deposited into Bank 3. Bank 3 holds 20% and loans out the rest. The cycle continues. This cascading chain reaction of successive loans and deposits is called secondary expansion. To find the absolute mathematical limit of this cycle, economists use a shortcut called the credit multiplier formula. You simply divide the number 1 by the reserve ratio. In our model, 1 divided by 0.20 gives us a multiplier of 5. When we multiply our initial $1,000 deposit by 5, we reach a final total money supply of $5,000. Only the first $1,000 was actual cash. $4,000 of that total is entirely new credit, willed into existence by the banking process. The banking system is essentially a financial cloning facility. The ultimate size of the money supply is dictated solely by the central bank's reserve ratio. But this purely mathematical model has a theoretical flaw. It assumes a continuous, unbroken demand for credit. For secondary expansion to actually happen, people and businesses must willingly choose to take on debt. The primary mechanism controlling that desire is the interest rate, which represents both the cost of borrowing money and the reward for saving it. This chart maps how raising interest rates acts as a systemic braking mechanism. An increase hikes the cost of borrowing and mortgage payments. When debt becomes expensive, businesses scale back expansion, and individuals reduce consumption. The macroeconomic outcome is a direct hit to the overall economy, leading to lower economic growth. Interest rates act as a physical throttle. When capital becomes too expensive to borrow, the cycle of money creation starves, and the engine slows down. There is one final, highly volatile variable in this economic engine: human fear. Changes in interest rates create a substitution effect. Every day, people weigh the incentive to spend their income against the incentive to hoard it for future returns. When individuals anticipate a recession, they increase their marginal propensity to save. On a microeconomic level, cutting consumption to build a financial buffer is a rational, protective measure. But the economist John Maynard Keynes identified a fatal flaw in this logic when applied to an entire society. This slide summarizes Keynes' paradox of thrift. He observed that if an entire economy attempts to increase aggregate savings simultaneously, the immediate drop in consumption actually lowers overall output, income, and employment. We can map this paradox directly onto our multiplier model. Remember the $800 loan issued by Bank One? If households panic and suddenly increase their savings, that borrowed money is hoarded. It is never spent at a business. Because the money is never spent, the local business generates no revenue, making zero deposits into Bank Two. With no new deposits, there are no subsequent loans. The entire secondary expansion chain collapses instantly. The mathematical collapse translates rapidly to the real world. Businesses face massive revenue shortfalls. Unable to pay operating costs, they are forced into mass layoffs. Because so many workers lose their paychecks, the total value of savings in the economy actually declines, despite everyone's desperate attempt to save more. The very act of mass self-preservation starves the interconnected credit engine of the deposits it needs to function. It proves that an economy's greatest strength, the mathematical multiplication of wealth, is also its ultimate vulnerability.